So, if you open your wallet or purse right now, there's a very good chance you've got a little piece of plastic in there that honestly feels a bit like magic. But today, we're going to look past that shiny exterior and really dive into the hidden architecture of credit card profits in this explainer. By the time we wrap up, you're going to understand exactly how banks are turning our everyday, mundane swipes into literally thousands of crores in revenue.
I mean, have you ever stopped to just ask yourself why? Why do banks so eagerly offer you money with this whole use now, pay later promise? Why are they so willing to give you a 2-lakh, 5-lakh, or sometimes even a 10-lakh rupee credit limit when you definitely don't have that kind of cash just sitting in your bank account? Honestly, it seems completely counterintuitive for a massive financial institution to just hand out unsecured money that freely, doesn't it?
Which naturally leads us to the big fundamental question. Are banks just being genuinely nice to us, or is there a massive hidden business model at play here? Well, we're going to follow the money today to see exactly how these institutions are generating such immense wealth. Spoiler alert, they absolutely aren't running a charity. There is an incredibly sophisticated, multi-layered system designed to generate revenue, and it's operating silently in the background of our daily lives 24/7.
Okay, to truly understand how this machine works from the ground up, let's bring in a protagonist. Let's meet Ravi. Now, Ravi is a salaried professional, bringing home a steady 50,000 rupees a month. He's your everyday guy, right? Just managing his expenses, paying his bills, trying to build a good life for himself. And because of that steady, reliable income, he represents the absolute ideal target for credit card companies. So, one totally ordinary afternoon, Ravi gets a phone call. The voice on the other end is super enthusiastic and says, "Congratulations, sir, your lifetime free credit card is approved." Ravi hears this and, like pretty much all of us would be, he's incredibly excited. And who wouldn't be? That phrase, lifetime free, is a ridiculously powerful psychological trigger. It makes us feel like we're getting this exclusive VIP access to capital with zero downside. And this whole setup brilliantly illustrates exactly why we love these cards so much. They literally shower us with rewards. Ravi is thrilled because he realizes he can use this new card for shopping at the mall, booking his vacation flights, getting those amazing buy-one-get-one discounts at restaurants, and even earning cashbacks on top of it all. It really feels like he's being financially rewarded simply for just going about his normal, everyday life. But wait a second. Here's the critical question Ravi finally stopped to ask himself, and it brings us to the very first hidden layer of this whole system. If the bank is giving you all these free offers, how exactly are they making a profit? Like, what's in it for them? Because obviously, giving away free flights and dining discounts costs some real money. Well, that curiosity pulls back the curtain on the very first pillar of credit card revenue, and that is merchant fees.
Let's break down what actually happens behind the curtain when Ravi buys, say, a 10,000 rupee mobile phone. He goes to the electronics store, swipes that shiny new card, and walks away happy, thinking he just spent 10,000 clean and simple. But the reality is totally different. The shop owner doesn't actually get all 10,000 rupees. They only get about 9,800, maybe 9,700. That remaining amount, that sneaky 200 rupees, gets sliced up and pocketed by the bank, the card networks, and the payment processing companies as a service fee, just for facilitating the transaction. So the crucial takeaway here is that even if you are incredibly disciplined and you never ever pay a single rupee in interest, the bank is still making massive profits off your daily transactions. Every single time you swipe, they take a small cut from the merchant. Now, zoom out for a second. Imagine this happening across lakhs of transactions every single day, multiplying into crores of transactions every month. Millions of swipes equal billions in hidden revenue. That right there is a multi-thousand crore income stream that is entirely invisible to you and me.
But honestly, merchant fees are just the appetizer. Let's see how this builds into the real jackpot for banks by looking at a typical billing timeline. So you have day 1, which is when you make the purchase, day 30 when your statement generates, and then day 45, which is the payment due date. Now this window feels like a really nice, convenient grace period for us consumers, but structurally, it's the perfect setup for the single most profitable mechanism in modern consumer finance. Let's see exactly how this plays out for our friend Ravi. So, Ravi had a pretty busy month, and his total spending hit 60,000 rupees. But when that due date finally rolled around on day 45, he looked at his bank balance and decided, you know what, I'm just going to pay the minimum due of 5,000 rupees. And the crazy part is, he actually feels good about this decision. He thinks he's responsibly reducing his debt while keeping some cash on hand for other stuff.
But here's the catch. That remaining 55,000 rupees doesn't just sit there peacefully. No, it becomes what they call a carry-forward balance. This unpaid amount gets pushed to the next month, and the bank immediately starts slapping on interest. And listen closely to this part because it's absolutely crucial. The interest rates on credit cards are significantly higher than what you'd ever pay on a standard personal loan or a car loan. Even worse, this interest compounds daily, growing larger and larger with every passing sunset.
The harsh reality is that the minimum due is a financial trap, perfectly designed to maximize daily interest. While you might feel this sense of relief paying only that tiny minimum amount, thinking you're managing your debt effectively, it is actually the bank's most powerful tool. It ensures you owe them compounding interest day after day, month after month. This mechanism alone is exactly what elevates the credit card business into one of the most highly profitable financial sectors in the entire world.
And somehow the story still doesn't end there, because banks also layer on all these small, easily ignored micro-charges. We're talking late payment fees, EMI conversion charges, annual fees, foreign transaction charges, and those absolutely exorbitant cash withdrawal fees. The bank has essentially found a way to monetize almost every single action you can possibly take with that little piece of plastic.
Now, a single late fee or an EMI processing charge might not seem like a big deal to one individual customer. You might just think, oh, whatever, it's just a few hundred rupees, I'll pay it and move on. But when you multiply these tiny, seemingly harmless slices across millions and millions of users, they snowball into a truly astronomical revenue stream. This is exactly why banks are always so desperately eager to issue new credit cards to literally anyone who qualifies. Every new customer represents a fresh, untapped source of these multiplying microcharges.
So, after seeing how this incredible machine actually works, the hidden merchant fees, the aggressive compounding interest traps, the endless array of microcharges, you might be asking yourself right now, are credit cards actually bad for me? Should I just take a pair of scissors, chop my card in half right this second, and stick to debit cards forever?
Actually, not at all. And this brilliantly illustrates the whole duality of the system. It completely depends on how you play the game. If you pay the full amount every single month before the due date, you win. It's that simple. You get the rewards, you enjoy the cashbacks, and you build a fantastic credit score without paying a single extra rupee in interest. But if you fall into the trap of only paying the minimum due, well, the bank wins, and they reap massive profits at the direct expense of your future wealth.
The ultimate takeaway from this explainer is super simple. Use a credit card to manage your money smartly, never as a lifeline when you're completely out of cash. Honestly, the biggest financial mistake you can ever make is viewing your credit limit as extra income. It's not. It is a financial management tool. And just like any sharp tool, it can either help you build something great, or it can cause some serious damage if you mishandle it. I really want to leave you with a powerful thought to remember the next time you open your wallet. There's a saying, making money is an art, but saving it is an even bigger art. Beating the bank at its own game by protecting your wealth, maximizing the benefits, and completely avoiding those traps, that is the true mastery of personal finance. So now that you finally understand the hidden architecture of credit card profits, ask yourself, whose pocket is your next swipe gonna enrich, yours or the bank's?